Welcome to This Explainer. Today we're tackling a classic investing dilemma by taking a really close look at Cadence Design Systems, or CDNS for short. We're going to explore a fascinating question. What actually happens when you find an incredibly profitable, high-performing business, but it comes with a sky-high price tag attached? Seriously, can a fundamentally great company turn out to be a terrible investment? Let's dive right in and find out.
Here's our quick roadmap for today's explainer. First, we'll look at the stock's massive returns, then we'll peek under the hood at its financial engine, examine that hefty price tag, and finally calculate its true fair value and safety margin. Okay, Section 1, Massive Returns. Let's start broad and look at the absolute powerhouse of a story that built CDNS into a $96 billion giant. 3,151%. That staggering number right there is the 15-year total return for the company. To put that into perspective, if you had held this stock for the last decade and a half, your initial wealth would have multiplied by more than 30 times. It's just a jaw-dropping figure. And, this growth isn't just some lucky fluke from the distant past. It has really sustained itself across multiple timeframes. Over the last 10 years, the total return is an incredible 1,349%. Meaning it's been compounding at over 30% annually. Even if we zoom into the relatively shorter 5-year and 3-year windows, we're still seeing compound annual growth rates of roughly 23% and 19% respectively. Make no mistake, this is a wealth compounding machine. Moving on to Section 2, the financial engine. So stock prices don't just go up in a vacuum, right? They follow actual business performance. And CDNS boasts an incredibly steady, reliable revenue growth engine. Over the trailing 12 months, they've grown revenue at 13.4%. And look at how tightly clustered that is with their 3-year and 5-year averages, which sit right around 14.5%. It really hasn't wavered much at all. That kind of predictability is exactly what big institutional investors absolutely crave. But it's not just about bringing money in the door, it's about keeping it. And their profitability is just as robust. They retain nearly 86% of their revenue as gross profit. That is an elite software-level margin. After you strip out all the operating expenses, taxes, and interest, they still turn over 20% of their roughly $5.5 billion in revenue into pure net income. It is just a highly, highly efficient business model. Well, what does management do with all that profit? How well are they actually allocating capital? Overall, it's really solid. A return on equity near 18% is great, and a return on invested capital of 12.8% means they are generating real value for shareholders. However, there is a slight crack in the armor to watch out for. That 12.8% ORIC is currently down about 41% from its 5-year average, so it is cooling off a bit from its historical highs. Now, moving over to the balance sheet, the financial picture gets a bit more complex. We're actually seeing a trend of declining short-term liquidity. While their overall debt load is totally manageable, both their current and quick ratios have dropped pretty significantly, down over 44% compared to their trailing 12-month averages. So while they can definitely easily cover their short-term liabilities, that comfortable cash cushion has undoubtedly shrunk. Okay, so we've established this is a fundamentally great company. We're talking strong margins, consistent double-digit revenue growth, and an incredible history of returns. But here is the million-dollar question. What are investors actually paying for this performance today? Does the current market price make any sense? Which brings us to Section 3, the price tag.
This is the narrative pivot of our explainer. Buying a great company at a terrible price can still totally wreck your portfolio. And honestly, the cost of entry here is wild. A price-to-earnings ratio of nearly 81 means you are paying $81 for every single $1 of earnings. The price-to-sales and enterprise value-to-sales ratios are both hovering around 17. You are literally paying 17 times top-line revenue just to get in the door. Even the price-to-free cash flow is sitting at a really hefty 66. The market is demanding an absolute premium here.
Perhaps the wildest metric in the whole mix is the PEG ratio. The PEG compares that massive price-to-earnings multiple against the company's actual earnings growth rate. Generally, a PEG of 1 means a stock is fairly valued. CDNS has a PEG ratio near 9.4. That indicates the market has basically priced in years of absolute unbroken perfection. You aren't just paying for the growth they've had, you're paying a massive premium for growth they haven't even achieved yet. And if you look at it from a yield perspective, the steepness of that premium becomes crystal clear. If you were to buy the entire business today at its current market cap, your immediate free cash flow yield is just 1.49%, and your earnings yield is a mere 1.22%.
These yields are well under what you could get from risk-free treasury bills. That really highlights just how much future growth you need this company to realize just to justify the current price.
Finally, let's look at Section 4, Fair Value and Safety Margin. Let's bring all of this together. How much should this stock actually be worth based purely on the cash it generates? Well, when we contrast the actual stock price of roughly $347 against a discounted cash flow fair value of $238, a stark reality emerges. The DCF model takes all those projected future cash flows and discounts them back to today's dollars. The math says the core business is worth about $238 a share. But the market is charging you $347.
So this gives us a margin of safety of negative 45.59%. The margin of safety is an old, reliable investing principle that suggests you should really only buy securities when their market price is significantly below their intrinsic value. Here, we're seeing the exact opposite. The stock is trading at a nearly 46% premium to its fair value, meaning there's absolutely zero buffer for error. If CDNS misses an earnings estimate, or if that nice, steady revenue growth slows from 14% to, say, 10%, the stock price has a long, long way to fall to reach its true fundamental value. To wrap up this explainer, I want to leave you with a final thought to chew on. CDNS has unequivocally proven itself to be an incredible company. It boasts elite margins and a history of phenomenal returns. But at a PE of 80 and a deeply negative margin of safety, is its steep price tag really justified? You have to ask yourself, are you comfortable paying for absolute perfection? Or is a negative 45% safety margin a risk your portfolio simply can't afford? Think carefully about that as you review your own investments. Thanks for joining me on this explainer, and keep learning.